to finish this up. It'll probably take another 30 minutes or so. So apologize, these are long videos, but they will get you through the chapter 4 activity. So what we got to complete first is our adjusted trial balance. And the way that we're going to complete that is by filling in the account balances for each of these accounts. So cash, we know, is an asset account, so it should have a debit balance because it is a debit normal account. The way we can look at that, if you notice, one thing about all these adjustments that we made, none of them impacted cash. And remember, the reason for that is because cash has either already happened or it's not going to happen until the future. So just remember, anytime we're dealing with adjusting journal entries, we're not going to be using cash. So the cash, we can just pull straight from the unadjusted trial balance, and we see that total is $98,000. Okay, so we're just going to write that right in here. Sorry, write that right there, and we go $98,000. Okay, then we'll move on to AR. Did we impact AR in any of our uh, adjusting journal entries? And we did. We did it right here by 10,000. So if we scroll back up, we can see what was AR originally, 280,000. So we are going to add 10,000 to that from right here. Okay, and that is going to be $290,000 now. Okay. Supplies, we did impact again. Remember, we saw that our ending balance in supplies was 8,000. And then we had prepaid rent. We started with 192. We reduced that by the 16 for the month. So we have 176 as our ending balance. Okay. We also had inventory. We didn't do anything with inventory, right? So none of these transactions mattered for affected inventory in any way. So our inventory is going to stay the same. It's going to be $494,000. Okay. We have equipment. We did impact equipment because we had some depreciation expense. However, remember, we don't actually change the equipment amount. So we've only got $250,000 in the equipment account. What we have changed, if we remember, if we look here, is accumulated depreciation. This is a new account on our adjusted trial balance. And how much did we add to that account? Well, it was $12,500. Now remember, accumulated depreciation is an asset account, but it is a contra asset account, so we put its balance in the credit column. Okay. Now we're done with assets. We're going to move on to payables. So you can see we've got all of our assets right here. Notice our assets go first, much like on our balance sheet. Now we're going to move on to liabilities, and we can see that right here are all of our liabilities. Okay. So accounts payable. Did we impact accounts payable at all? I don't believe that we did. So accounts payable is going to remain the same at $14,000. Salaries payable, we did increase. This is a new one for us, right? If we looked back up at our unadjusted balance, salaries payable is not going to be there. So we do have a new account here for salaries payable. And those salaries payable were totaling $3,000 if we go back and look at that journal entry. Okay. We also have a new account in interest payable. This is one that we had to add because we did not have it previously in our unadjusted trial balance. So our interest payable is $6,250. And then we have deferred revenue, and that is going to be $7,000, right? So if we scroll back up to our, sorry, went a little bit too far. We look at our deferred revenue here was $12,000, but if you recall, in this journal entry here, we recognized $5,000 worth of it as revenue, and so we reduce it by that $5,000. Okay, and then we have notes payable. The notes payable is going to stay the same because we haven't actually paid anything on it yet, right? So it's $250,000. Remember, we don't pay it until the note matures. Okay, so it'll stay the same. Now we're going to move to our equity section. You have common stock, retained earnings, dividends, revenues, expenses, all that good stuff. This is our equity section of our balance sheet. So you can see this adjusted trial balance, right, is just here to show us that all of our debits, all of our credits are equal. And we're going to do that using balance sheet accounts here. I mean, we do have income statement accounts down here in our revenues and expenses, but we're going to look at this as assets go first, then liabilities, and then you list your equity, just like with your accounting equation. Okay. So let's look at common stock. Common stock, we did not impact at all. So if we go back up to our trial balance, we can see common stock is at $1 million. We're just going to stay at $1 million there. Okay. Retained earnings. Okay. Retained earnings, we had none, right? It's the first year of operations. We didn't have any earnings from last year to retain. Dividends, we didn't impact dividends at all in our adjustments, so we're going to go back up here. They were 14,000, so we'll transfer that back to our adjusted balance. Okay, remember they have a debit balance. We're going to put them in the debit column. Sales revenue, we did not have any additional sales revenue. Okay, so that's $350,000. But we did add some service revenue here. Okay, so that's our new one. Our service revenue was from it was from our uh, sorry, from our deferral earlier. Okay. And then we've got cost of goods sold. Again, we didn't impact that. So if we scrolled up, we would see that was 250,000. We had salaries expense, right? We did have some salaries expense of 31,000. Okay. We had some rent expense for 16,000. This one again is a new one for us. We have supplies expense that's new. We have depreciation expense that's new. We also have interest expense that's new. So all of those are new to our adjusted trial balance because those are accounts that we had to adjust. So the supplies expense, we had $12,000 worth of expense. Depreciation expense, we had 12,500 of. Okay. And then our interest expense, we had $6,250. If we add those all up, what you end up getting is $1,657,750 on both sides. Okay. So here we can see our debits equal our credits, and we are pretty happy about that. Okay. The next thing we're going to do is we're going to calculate the totals for our income statement, our statement of equity, and our balance sheet. And the way we're going to do that is we are going to just add everything up. Okay. So let's start with our income statement. Our income statement just has our revenues and expenses on it. That's all we care about. We just want to know what is our net income at the end of the day. So if you look back at your adjusted trial balance, you'll see that we had sales revenue, we had service rev, we had some cost of goods sold, we had some salaries expense, we had some rent expense, we had some supplies expense, we had some depreciation expense, and we had some interest expense. Okay. So all I want to do here is just total those up. So the sales revenue was 350,000. Our service revenue was 15,000. Cost of goods sold was 250,000. Our salaries expense was 31,000. Okay. Our rent expense was 16,000. Our supplies expense was 12,000. Our depreciation expense was 12,500. And our interest expense was 6,250. Okay. So what we end up with here is we end up with a net income of $37,250. Okay. So we're just going to add that here. And that'll be your answer for what were your income statement totals. Now we'll move on to our statement of equity. Okay. And what we will have is we'll have to calculate a couple of things, but they're pretty simple for us to calculate, right? So what we're going to have is we're going to go from our net income of 37,000 less our dividends, and that's going to equal our retained earnings, right? So we take our net income, 37,250. We're going to reduce that by our dividends of 14,000. Okay. And you're getting all of this from your adjusted trial balance. You're just pulling them straight from your adjusted trial balance. Okay. And so what we end up with is total equity, or excuse me, total retained earnings of $23,250. And then we remember that in order to find our total equity, okay, we take our we're going to take our contributed capital, or the common stock, which was $1 million. We're going to add our retained earnings to it. Okay, that was 23,250, and that's going to give us total equity, right, of $1,023,250. Now remember, what we've got to figure out is, does A equal L plus E? Okay, so we need to find our total equity here. Our total equity was $1,023,250. What were our total liabilities? Well, if we go back and add all of our payables and our deferred revenues together, we'll see that they equal $280,250. And then our assets were 1,303,500. If you do the math, this equals this plus this. So we are in balance. Okay. So we'll go back to this and we'll say our retained earnings was 23,250. Okay. Total assets was 1,303,500. Total liabilities were 280,250. Total equity was 1,023,250. Okay. Does it balance? Yeah, it does. Okay. Remember, these equal this. Okay. All right. So the last thing we got to talk about are these things called closing entries. Surely you guys have heard the phrase "closing the books," right? You're closing the books, and that's essentially what we're doing here. What we're really doing at the end of the day, what we're essentially doing is we're taking all of our revenues, we're reducing them, and we're closing them out to retained earnings. Okay? We're taking all of our expenses and we're closing them to retained earnings. And we are taking all of our dividends, okay, and we're closing them out to retained earnings. So if you remember what these accounts look like, you've got revenues, okay, they increase with a credit, decrease with a debit. You've got expenses, okay, they increase with a debit, decrease with a credit, and you've got dividends. Okay. Again, they're going to increase with a debit, decrease with a credit. All I'm saying here, all we're really doing is you're taking your ending balance and you want it to be zero. Taking your ending balance, you want it to be zero. Taking your ending balance and you want it to be zero. The way you make these zero is, let's say you have $100 in revenue, okay? How do you get your ending balance in an account to be zero? Well, you take, excuse me, sorry, you take all of your increases less all of your decreases and make it equal zero, okay? Make sense? So essentially what we're going to do here is we're going to say that, let's take a look at revenues here first, all right? We're going to say all of our revenues, if we go back and look at our, trial balances, right? We had 350,000 and we had 15,000. So we had really, well, I got to put these in the right order for you guys. Sorry. Oh, don't get confused. Don't let what I'm doing confuse you. Okay. So we had 350,000 and 15,000 in here, which means we had a balance of 365,000. We want that to be zero. The way we're going to get to be zero is we're going to put 365,000 in the debit side here. And we've got retained earnings account. Okay. Retained earnings is an equity account. Okay. So what we're going to do with that is credit to increase, debit to decrease, right? So if I am debiting revenues for 365,000, I'm going to credit retained earnings for the same amount, okay? What that does is it increases retained earnings by 365,000, okay? And I want to do the same thing for expenses here, okay? So with expenses, well, let's look at the actual journal entry for retained earnings, the way it's going to be written up in your, or for revenues, excuse me. We're going to have uh, revenues right here. We're going to close them for 365,000 by debiting them. This takes their account balances, their ending balance to zero. And we're going to credit retained earnings. This is going to increase retained earnings by $365,000. Okay. Now we're going to do the exact same thing with expenses, except if you look at, if you look at an expense account, we debit to increase, we credit to decrease. So if we want expenses to be zero, we have to credit the expense account for the amount, and then we will debit the retained earnings for that amount, and it will decrease the retained earnings ending balance. Okay, so we're going to go ahead and do that. And we're going to say, well, we're having to debit retained earnings, so we know it is our first retained earnings account, or it is account. Okay. And if we added all of our expenses up, they'd be $327,750. Okay. What are those expenses? Well, we had COGS, we had salaries, we had rent, we had supplies, we had depreciation, and we had interest. Okay. So all you do now is you just fill in those amounts. So 250,000 for cost of goods sold, 31,000, 16,000, 12,000, 12,250. Nope, excuse me, 12,500. And 6,250. If we add all of these up, they equal that amount right there. Okay. Now what that is doing, remember, is it is actually reducing the retained earnings account. So if we added these together, we would have a retained earnings ending balance of whatever that is. But don't forget, we've also got some dividends. Dividends also have to be closed to retained earnings. Same way we do expenses, right? We're going to increase dividends with a debit, so we'll decrease it with a credit. Whatever our amount was, and it totaled $14,000, we're going to credit it so that we've got a $0 balance here. That credit goes to retained earnings as a debit, okay? Which again is decreasing your retained earnings amount. So if we go back to our journal entry here, we'll see that we are going to, again, debit retained earnings, okay? Debit it for $14,000. We're going to credit the dividends for $14,000, okay? And then what we end up seeing is that your total retained earnings number will equal this, right? But we've just walked through how we got to that retained earnings number. Essentially, really all you're doing is you're calculating that retained earnings portion of the, calculating that retained earnings portion of the accounting equation, right? That's all we're doing with this. That's all that is, okay? We're literally subtracting expenses from revenues and dividends from net income, and they become your retained earnings. That's all you're doing in a closing entry. It seems really complicated. It's not. You are just calculating your retained earnings, okay? The final thing you have to do before we, we've already produced our financial statements. You produce your financial statements after the adjustments because those are going to give you all of your correct account balances. What we're going to do next is we're going to create our post-close trial balance, okay? The post-close trial balance is after we've closed all of our accounts. We close all of those revenue and expense accounts and dividends accounts. So what you will not see on a post-close trial balance is any kind of revenue, expense, or dividends, okay? All we're doing is basically taking the numbers that we had from our adjusted trial balance, and anything that's a revenue, right? You're not going to have any revenue. You're not going to have any revenue. You're not going to have any expenses. Okay, all of those will be gone. None of those will exist on the post-close trial balance. Okay, so all we got to do is just fill these out. The way you're going to fill them out is just say, oh well, cash we still have $98,000. Okay, we have $290,000 in receivables still. We have $8,000 in supplies. We have $176,000 in our prepaid rent asset. We have $494,000 remaining in our inventory. We have $250,000 worth of equipment. And we have $12,500 worth of accumulated depreciation. Okay. These things are all your all of these are your balance sheet, right? Or the assets section of your balance sheet, okay? This is all from your assets section of your balance sheet, okay? Next, we're going to look at the liabilities section of your balance sheet, okay? So we're going to say, well, we still had $14,000 in payables. We had $3,000 in salaries payable. We had $6,250 in interest payable. And we had $7,000 worth of deferred revenue, okay? And then finally, we still had $250,000 left on that note that is not yet matured, okay? So now we can look at and see, oh, well, all of these yellow ones right here right? This is all just your liabilities from your balance sheet, okay? And finally, we'll look at what was our common stock. Well, common stock was $1 million. That didn't change. And retained earnings ended up being $23,250, okay? This, right? This is your equity from your balance sheet. The key that I'm trying to get to here with this post-close is only balance sheet accounts remain. Only balance sheet accounts remain because they are what we refer to as permanent accounts. They never go away. They simply roll their balances forward. Whereas your income statement accounts, they're what we call temporary or nominal, okay? We close them to zero so that they are prepared to start tracking the new balances every reporting period, okay? So again, if we add all these up, we'll see that we have $1,316,000 worth of debits and the same amount worth of credits. Debits equal credits. We're happy. No errors that we're aware of, and account balances are correct. We're happy about that, okay? That is activity 4. That is the activity for chapter 4. If you have any questions, make sure you're reaching out to the past mentors. Please, please, please reach out to Maddie. Her information is on Brightspace. You need to be reaching out to her to get some help.